Yeah, yeah. We live. We live. What's going on, y'all?
Sir, what's the deal?
Happy Thursday. Happy
Okay,
Thursday. How you feeling?
good.
Good. There was a lot of prayers out there for you.
Appreciate it.
Yeah, yeah. I stopped by the old high school. They was like, "Yo, you okay?" I'm like, "Yeah, I'm good." They like, "Shot, you okay?" I'm like, "He fighting. He fighting." Ab okay? He getting there. We all right, y'all. We getting there. Shout out to everybody that sent their prayers, man. Everything looking better on the up and up.
Yeah, for sure. So we back. Another great live ahead. We're gonna be going over how to improve your credit. Pretty straightforward, as fast as possible. And that's something that obviously is vitally important in life. A lot of people might have made a bad decision here and there, just got caught up, didn't realize that they paid a bill too late, and want to buy a home now or want to get a car or do a variety of different things, and your credit score is stopping you or slowing down the process. So improving your credit score is something that's very, very, very beneficial and helpful. So we're gonna bring our guest on in a minute. Shonda Martin, somebody she's been at InvestFest. She's done episodes. She's done events with us when we was in Oakland with
Hmm.
Chase. So expert in the field and somebody that's just been like a really good communicator as far as helping people and teaching people, like, no gimmicks, no, you know, strings attached, just like real information that's important, especially in this space. A lot of times there's, a lot of strings attached when it comes to the credit situation, but this is straightforward. So we're gonna be getting into it. But before we do remember, if you haven't, get your copy. You Deserve to Be Rich.
Yeah,
It was vitally important. That's the blueprint for financial freedom. We put together New York Times bestseller
that's a fact.
in less than a week. It's been out for around 2.5 weeks now. So shout out to everybody that did get a copy,
Yes.
Audible, um, downloadable version, hard copy,
Large print.
everything that you could think of, man.
Yeah.
But yeah, don't forget, man. That's something that timeless piece of work
Yeah.
that you could pass. You can give to other people. You can gift it. Vitally important. So get your copy of You Deserve to Be Rich,
Yeah.
New York Times bestseller.
And when you purchase it, man, we love it. Shout out to everybody that's been showing love, posting the book, tagging us in it. I'm trying to post as many as possible. We appreciate the love, but we got to keep this thing going. So when people ask us, where do I start? Where do I start? My new answer going forward is you deserve to be rich. Everything you need is inside that book to get your game on track. And so we hope that you get it, enjoy it, but most importantly, implement and execute on the information inside. You got to do it. Got to do it.
Yes, sir. All right. So now we're going to bring our guest up.
Let's do it. Let's do it. Let's do it. Hey, hey.
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 Sandra, what's going on? How you feeling?
I'm good. I'm excited. Man, listen, I love talking about credit. I love teaching people how to, improve their credit score. So I'm in seven heaven right now. Like, I'm ready.
Yeah, our audience loves every time you are on the platform. You notice a pattern here. These numbers
Yeah.
go crazy because every credit is something that we don't know a lot of information about, but we definitely need it. And if we have it, we definitely need to improve it or find ways to improve it and update ourselves on it because the information changes. Information changes from year to year.
That's true.
So I'm
That's
happy we
very
have
true.
you.
Yes, no, I'm excited. And shout out to y'all audience, because I feel like they just get me. They always show me love, and yeah. And they're action takers. Like, that's probably my favorite part about them. It's nothing better than like providing information or resources and being able to witness the person actually implementing those changes. Nothing better. So I'm all for it.
That's a fact. That's a fact. So, okay, we're going to get into it. I know we got a lot to talk about. So I'll let you kick it off.
Okay. So first I want to say that I was tasked with probably the hardest, most simplest task ever. And that was accumulate a list or a set of tips to help people boost their credit scores. Now, as an expert in the field with all of my experience, it should be like super easy. Like, that question is like it should be super easy. But for me, questions like that always pose like the hardest, like it's always the hardest for me, because I always want to make sure that I am giving actionable advice that is not only practical, but it isn't like they can start implementing it immediately. And that's usually like that's the lane that I like to take. And I wanted to also approach this with like not necessarily like surface level information that like people can just go on Google or have been hearing routinely. Like I wanted to really take a look back at like at all of my most consistent strategies that just work and are tried and true and that I'm willing to bet the farm on. And I've been able to compile a pretty extensive list of a very strategic but actionable and specific key points that I want to focus on today. So again, I'm excited, but like I said, it was hard.
And that's why we appreciate you, because your attention to detail, but more importantly, you care about people and you care about their results. And so again, we're happy to have you, man. So where do we start? Where do you want to start?
Where do we start? Okay. Whew, that's a loaded question. Now, when it comes to credit scores, a lot of time people are often only focused on like the numerical value of their score, like their credit score. I want to get a 700 credit score. I want to get an 800 credit score is usually like the request that I receive daily. But I'm a big believer of focusing on your credit profile, strengthening that. It does more for not only your credit score, but your borrowing power overall and your entire credit standing. So every time that I approach advising someone on how to repair or improve their credit score, it is never solely based on points. So I just wanted to say that first. And also, in order for anything that I'm going to say to make sense, you have to the audience has to be willing to unlearn certain things that we've been accustomed to when it comes to like the credit game that are just flat out wrong, right? And so yes, I wanted to first give that disclaimer before we kind of get into these tips. And if you guys are ready, I can start with I'll start with the most effective one or the one that will cause the most immediate boost.
Yeah,
If
let's
you don't
do it.
mind.
Let's get it
Okay.
going. Let's do it.
All right. So my number one non-conventional tip that I would recommend for a person seeking to boost their credit rating is to number one, target the late payments. The reason why you want to target the late payments anytime you are trying to improve your credit score is because of the impact that the payment history has on our credit scores, because it's the largest factor. It's responsible for 35% of our credit score. Also, it holds over 192.5 points. So we want to get as many of those points as possible in order to reach a high credit score. So with that being said, the first thing that everyone needs to evaluate on their credit report when they're seeking immediate change in their credit score is trying to reverse the impact of the late payments that they have on their credit report. This happens only one way. So the way that they would do that is because late payments are the number one reason people will lose 50 to 100 points per instance sometimes. And like I said, because it's the largest factor, the only way to undo that impact or neutralize the effects is to flood their reports with on-time payments. How to do that? It's easy if you think of it from this lens. I call it the 11-to-1 rule, right? So what that means is for every single late payment that is reporting on their credit report within the last 3 years, they're going to need 11 on-time payments to neutralize that negative impact on their score. How do they get that? You can do it by multiple ways. Number one, you can allow time to pass. That's about a year. 11 months is about a year before most late payments will neutralize. But being super strategic and intentional about making sure that they are trying to cancel out the late payments within the last 3 years by specifically making sure that they have accounts that are currently reporting every single month to every single credit bureaus in on-time payment. And it has to be within that same category. So what that means is like if they have 2 late payments on a credit card within the last 2 years, then their goal is for the next 11 months is to get 22, 22 on-time payments reported within a credit card account. Right? It doesn't have to be the same account. It just has to be the same type. Does that make sense?
I'm with you.
Okay. Then the next thing that they would do to target late payments on their credit report is to request a goodwill adjustment from their lender, right? Now, there are going to be some payments that they will struggle with getting removed, or some payments that they probably will not be able to amass enough on-time payments in a timely fashion, depending on how many that they have. So my rule of thumb is for any accounts that is still open, so it's still reporting, you still have a standing relationship with the creditor, you should always request a goodwill adjustment from them. And that's simply just going to the creditor saying, "Hey, I made a mistake. I was late. I'm not denying it. Things came up, things happened. I learned. Are you willing to erase that late payment record from my credit report?" And that's called a goodwill adjustment. Now, a lot of lenders will grant this. Capital One is one company, Credit One is one company that is notorious for accepting and honoring goodwill requests, right? So yes, if you have Capital One, you have Credit One, or any bank that you have, make sure you are mailing a goodwill request letter to the creditor to ask for a goodwill adjustment for every single late payment within the last 3 years, right? So that's sort of like the first tip all in one. It was two tips all in one, which is to target the late payments within the last 3 years and trying to erase as many of those as possible.
So the goodwill adjustment, this is a one-time letter that can knock out a few payments, right? So this is not like I was late once, can you forgive me once? I might have been late 4 times in 2024. I'm sending this letter on behalf of 2024 for this adjustment. Can you forgive all 4? Is that correct?
Yes. Yeah, you are correct. So you can technically ask for any amount, right? Now, keep in mind, granting a goodwill letter is up to the company. It's at their, they can decide to obviously deny it. And it is based on like the history that you are building with them. So they can say no. However, if you guys don't mind, I want to show an example of a template that they can use to send. All they have to do is plug and play their information and send it to their creditor. And so let me share that really quick. And it's just a good letter to have just in your file, just in case, So are you guys able to see that clearly?
Yeah, we got it.
Okay, good. So yes. So this is an example of a perfect formatted goodwill template, right? All they would do is obviously the red writing, they would replace it with their information and then send it via mail. Either send it via mail with only one exception, if they have access to the CEO's email address, which is a hugely slept on method of goodwill adjustments that burns me that people don't utilize that method. However, so just send a goodwill letter, send it in the mail, or if you have access to the executive or CEO's email address, then just send it directly to the email. And so you would do that for each late payment. You can if you have 7 late payments, you can literally fill out 7 of these, or if they're on the same account, of course, then you could just list them all out. You want to specifically focus on the late payments within the last 3 years, because those are the ones that's like weighing the heaviest on your score, affecting your borrowing power the most, and really are like probably the reason why your like a person's score is just stagnant or being affected the most. So targeting late payments within the last 3 years is rule number 1. That's going to any late payment, any single instance of a late payment that is removed, that is forgiven, they stand to see an increase of 30 to 60 points per late payment. Like it's that big of a deal. And as I stated, like you would be so surprised to see how often the goodwill requests are granted, and also how effective the making sure that you are flooding your credit report with on-time payments to neutralize previous late payments. How effective that method is in the night and day difference that it makes on, within a person's credit profile. So that's like rule number 1. Target late payments within the last 3 years.
All right. So I got a follow-up, right?
Yeah.
So I got the goodwill adjustment letter, right? But sometimes I might have paid it and it registered as a late payment. How do I dispute? How do I try to get that error off of the report, right? Because sometimes it's not my error. It might be on the lender's error.
So Was it by way of a mistake? So you were not late, but somehow, some way they reported you late,
They
or
reported me late, but it really wasn't.
oh well, if it was their fault, then that should you definitely need to take that up with the company first. Like request that they send you a copy of your records, your payment record. Or if you have proof that you paid it, so like if you pay with your bank account or credit card and you have a record of you paying off your credit card in a timely fashion, then you can just go ahead and send the proof to the credit bureaus, letting them know that the company is wrong. But if you don't have proof of it, you are at the mercy of them providing you their records. And you are going against them, so they can definitely be like, well, no, we don't have a record of it. So it's always best to obviously keep our own documentation, because they're never on our side when we're up against them.
Document the process. Got you.
Keep everything. Keep everything.
Okay. All right. So that would be the first step.
First step, yes. And then the next thing that I would advise that would, like I said, make the most immediate or biggest impact on one's credit score, it would be, so I want to first frame this one. The next tip is relating to credit utilization as well. However, it's in a different capacity. So what I mean by that is, like, my second tip is to lower let me rephrase that. Lower your credit utilization before their next statement date, right? And what that does, or just in general, learning how to properly pay your credit card, learning how to pay your credit card in a way that it maximizes your credit score and increases your borrowing worthiness, will always be something that, like I always say, everyone that has a credit card needs to know how to properly pay a credit card, and needs to know that there is a strategic way of paying it that aids to increasing your credit score. And the stereotypical or the standard way that we are paying our credit cards actually leaves about 80 points on a table that most people can literally access within 30 to 60 days by just reframing how they are paying their credit cards. And obviously I'll get into exactly how, but let me put an example on the screen. Give me one moment just to make a little more sense. But okay. Now, when it comes to paying off your credit card, the first thing that I need everyone to evaluate for every single credit card that they have is to identify these two important dates. The first date I want them to identify is their due date. That's not the first day I want them to identify is their due date. It's not up yet. And then the second date I want them to identify is their statement date, and understanding the difference. The biggest difference between these two dates makes the biggest difference in your credit score, because your statement date is the dates that will determine how many credit points you are getting as a result of your credit utilization. And then your due date only matters to your bank. It does not affect your credit score. It does not affect how your credit cards are reporting. So that is not the date that is important. The date that is important is your statement date, right? And it's so important to the fact that, like, if you are not ensuring that your balance is below 10% of your credit limit at least 2 to 3 days prior to your statement date, then you are leaving a wealth of points on the floor. You are leaving a wealth of points just sitting there, and you are not being credited for really having that credit card, right? So I can either go through how I typically pay my credit cards, or if you guys have like a specific question in regards to like the differences of it, I can,
Yeah, I think if you go through how you do it, that would be
Mhm.
helpful for sure.
Okay, cool. Now, what I do is, there's two golden rules that I have for my credit cards. Is I have a rule that by my due date, I make sure that my balance is zeroed. So I zero out my credit card by my due date. And that's simply because I want to avoid paying interest, right? So that's a personal qualm for me. I don't like paying unnecessary fees, right? However, that doesn't help my credit. When it specifically comes to my credit report, I also make sure that 3 days prior to my statement date in every billing cycle, so every month, that I have reduced my balance down to 10 or reduce my balance down to under 10%. And that way I can ensure that the balance that's being reported to the credit bureaus is favorable. And also it is showing that I am a responsible borrower. I not only use my credit card, but I can be trusted to pay it back. Right? That's super important. Most people are usually under the guise that as long as they pay their credit cards by their due date, then they're good, right? And also, or the other thing that I see is a person would zero out their credit cards on their due date, and then not necessarily have any inclination that how important their statement date is. So they don't even care what their balance is on their statement date, because they're unaware that that payment that they made on their due date is not being credited for their, and used as their utilization. Like, I think so. That's pretty much like the golden rule with credit cards. You just have to make sure that your statement date is being prioritized. Like, you have to make sure you are prioritizing the balance that your credit card is reporting on your statement date. And I always say, if you don't know or understand this, look at your most recent credit card statement, right? On your credit card statement, you will have what's called a statement balance that's required for every credit card statement. Your statement balance, that is your utilization that was reported to the credit bureaus from that bank the month prior, right? So anytime you ever wonder what your utilization is, all you have to do is look at your most recent credit card statement, because your statement balance is your utilization. That statement balance is important because that's the key to unlocking as many points as possible within the credit utilization category, right? Which lends to 165 points. So we need all of those points, was as many of them as possible. And the only way that you'll have access to majority of those points is if you are strategically paying your credit card based on your statement date, and obviously keeping a low utilization. Low is not 30%. Low is not anything other than what's considered good and low to lenders is literally between 1 and 9%. That is like the pristine range, the most optimal range. That is the range that if you are wanting or seeking to improve your credit score, if you are reporting anything above 9% repeatedly on your credit on your as your credit utilization, then you are not going to increase your credit score. Like, it's just you don't want to increase your credit score, because it just won't happen. Now you may get a few points here and there. However, if you want to see a real change in your credit score, making sure that you are reporting between 1 and 9% by your statement date for every credit card, that's what's going to unlock like that next level of credit for any literally any profile.
This is pretty tricky, right? Because again, and I like what you said there, between 1 to 9%. But
Mhm.
you didn't say 0%, right? So most people that will just say, I'm going to use my credit card, I'm going to pay it off, right? I'm going to use my credit
Mhm.
card, I'm going to pay the whole thing off. Probably not the best method if you're trying to increase your credit score, because it doesn't really show there's a payment history, right? They actually want you to have some leftover, right? Between that 1 to 9%, so that you can continuously pay them every month, right? Paying off the balance every month is not the best solution. People, it's like confusing. What's your thoughts around that?
Oh no, you were spot on. You were certainly spot on, because yeah, that is a common misconception that people have when it comes to credit cards. Is like reporting a $0 balance is good, or a lender would like prefer that. And nothing can be further from the truth. In fact, I'll show you a visual to make it easier for someone to like understand how lenders view credit utilization ratios. Like, they're super important. And like I said, this is probably the number one thing that affects borrowing power in terms of like credit card limits, the interest rates that one would receive when they're applying for anything. So if you're a person that finds yourself only being approved for up to a certain amount, or never being able to cross a certain threshold or tier when it comes to borrowing, it's usually probably because of your utilization. And I'm pulling up that chart right now.
And while you're doing that, like for
Mhm.
the statement date, can a statement date just be the same day as your payment date?
As the due date? No. So they're different. Your statement
I'm saying,
date is the
can you make it the same day?
Oh, actually, some banks will allow you. So it's up to the bank, and some banks will refuse it. But like honestly, a lot of banks will allow you because they want your dates to make sense for you. They want whatever's best for you to pay them back. They are usually willing to like accommodate that request. So I'll ask. And also that brings me to another point. If your credit card statement date or your due date is during a time of the month where like you don't typically have extra finances, if it's right after you have to pay like a large bill like rent or something like that, you are able to request for your dates to change, your payment dates to change on your credit cards. Do what is best for you. Do what will help you to actually pay the bill. Like so. Yeah, that I'm glad you brought that point up.
Yeah, if you ever had an American Express, you definitely are familiar with that. Like that, and that takes a while to even figure out like what the statement dates are. Is between the 25th to the 24th, and then the due date. Obviously, you can change it if it's mid month. Like you said, a lot of people get paid bi-weekly. Some people get paid monthly. Having the
Mhm.
15th as that offsetting day gives you some time, or the 16th gives you some time to get that money into the account. But yeah, they're two different things, man. I'm glad you brought that up. Very
There's
important.
two different things. They are, and I'm uh showing a screenshot. Let me know when you guys can see it. Are you able to see that?
Yep, we got it.
Okay, perfect. So this is just a a quick reference point that everyone needs to remember when it comes to paying your credit card and understanding utilization tiers and how they impact our credit scores. Now, your credit utilization will affect both your credit score as well as your borrowing power. Like I said, it affects pretty much everything with credit. So it's super important that you understand it. Reporting the wrong utilization can cause 40 plus points. And when I say wrong utilization, I want to stress how the wrong utilization is quite literally what we are taught. So it's the normal advice. So majority of consumers are following the wrong utilization advice. And that's the industry standard of making sure that you report 30% of your credit or 30% of your credit utilization, or making sure that you stay under 30% and you are fine. No, if you look on this list, you would notice that 30% is red. 30% is considered risky, right? Um, the next tip will go a little more into detail about utilization specifically, but I cannot stress how important it is. If, like I keep on saying, if you are a person that is seeking to improve your credit, um, then do not go past 9%. Don't go past this second level if you want to actually see a difference in your credit profile. That's just stop right there. Because anything above that, then you are losing points. You are losing points. You're not maximizing the points that you are receiving for your credit utilization. You're just leaving points on the table, right? So this is just kind of like my standard advice when it comes to the tiers, right?
Yeah, Sean, a quick question, because and there might be some people who are not even familiar with, don't know their credit score. Number one, not knowing that they can access it for
Mhm.
free. But number two,
Yeah.
what is the range now, right? Because I remember 800 was the max score. Is 850 now the max score? Like that's being the highest. This is really a trust system, right? How much the banks trust you will determine how high your
Mhm.
score is. What's the range that it falls into now?
Oh yeah, so credit scores range between 300, which is the lowest, and 850. The reason why it's 850 is because like the most widely accepted version of our FICO scores goes off that 850. So we kind of just, accept it as like the standard. So yeah, so between 300 and 850. Can't go below 300, can't surpass 850. So we're giving 300 points. So it doesn't matter how bad your credit report is or your credit how many collections you have, you cannot go under 300 credit points, right? So the entire point and goal of maintaining or obtaining good credit is seeking to get as close to 850 as possible. which math wise, that's just the difference between 300 and 850 is just 550 points, right? So if you think of credit, if we think of our credit scores in that capacity, where you realize that there are 550 points that you could potentially get, right? And those 550 points are broken down into 5 separate categories, which is payment history. Payment history takes up 192.5 of those 550 points. Credit utilization takes up 165. Credit age takes up 82.5. And then credit mix and hard inquiries both take up 55 each. So if you add each of those categories together, it'll equal 550 points, right? And in order to get a perfect credit score, you would have to have a perfect credit report and not have any derogatories or be missing any of those points. There's no reason to aim for a 50 credit score anyway, but that is the highest possibility. Now, I always, when it comes to boosting credit scores and increasing your credit scores, I mainly focus on the top 2 categories, which is payment history and credit utilization, because just mathematically, if you are doing even moderately good, and when I say moderately, I'm talking, let's just say, for example, 60 or 70 to 75% doing good in those areas and getting about 75% of those available points, then the lowest that your credit score can even reach is a 680, right? And in case someone is not familiar with how credit score ranges are graded, a 680 is the lowest possible score to be considered to have good credit, right? So that's like the floor of what's considered a good credit profile or a good credit score. And I want to stress that point because I always tell people that if you do not have at least a 680 credit score, then there is something very wrong within your payment history or your credit utilization that needs to be addressed immediately. Because as long as you fix that or pay attention and be intentional about fixing whatever it is within your payment history or your credit utilization, which off the back, I'm just going, from my experience, is usually high utilization above 30%, or late payments within the last 24 months. Those are the top 2 reasons why somebody usually does not have a 680 credit score. If those 2 things are not, does not apply to someone and they have below a 680 credit score, then it's usually like maybe they had like a bankruptcy or something like drastic. But if you don't have at least a 680, then there are very actionable and practical, easy changes and switches that you just need to make, like what we're going over today. And you can get a 680 within, I don't want to promise a certain time limit because it depends on the profile, but very quickly, very quickly.
Yeah. Now, late payments, student loans count inside of those late payments?
Yes, every account on your credit report actually, every late payment on your credit report counts towards your payment bank or your late payments. So yeah, no matter how old, by the way.
Pandemic, we had that pause. Make sure y'all paying your student loans. So we got target late payments number 1. We got lower utilization number 2. What we got at number 3?
Number 3. So this definitely is going to require a visual because I want to make sure that people are following it, because it's a little more nuanced than the last one. Hold on, give me one. I'm gonna focus on one other one before I hit that one, just
Gotcha.
for easier explanation. All right, now the next tip or credit strategy that I would recommend to a person who is trying to increase their credit score within the next year. This is one of my low-key favorite ones because it's one of the ones that is usually never, ever, ever thought of or mentioned or even taught. This is specifically for people who have charged off accounts, right? Now, at the mention of charge-offs, there are so many people that probably had a visceral reaction like, I'm not getting a charge-off removed. Just the repetition of a charge-off is usually attributed to that being the hardest account type to get removed from your credit report, right? That's one of the worst credit instances or the worst types of derogatory accounts that is on our credit reports, and it causes a lot of damage, right? And so most people, they either try to dispute that account, but most people don't have luck with getting them deleted. But that's simply because they usually are disputing it incorrectly, right? Now, I didn't want to get much into credit repair or credit dispute tactics. However, this one is worth mentioning. If you have a charge off on your credit report, what I need you to do is, number one, you need to download your official credit report. You would do so by going to annualcreditreport.com. It is free. You get a free copy of all 3 of your credit reports. You need your official credit report and not like a credit monitoring app, specifically because our official credit reports contain so much more information and details about each account, right? And that information is what you will use and what you will need to determine if that charge off is considered valid, right? Now, the second thing that I want them to do is, once they get their credit reports, look at their charged off account and look at how it's reporting on their credit report. And they need to look for 2 things. The first thing that they need to look for is if that charged off account if that charge off account still is carrying a balance, right? Is it reporting a balance? Does it say $0? Or does it still, if it was a repossession that was charged off, for example, does it say you still owe $12,000 or whatever on that account, right? So determine the balance on that charged off account, okay? If that charged off account has a balance that has been updated after the account was charged off, then you need to challenge that. Most people don't challenge charge-offs correctly. They usually challenge it the standard way that we challenge our credit report, which is usually like based off either random letter templates that they found online, or mainly focus on the FCRA laws, which is the Fair Credit Reporting Act. And those are just a host of consumer laws that we usually, use to challenge credit reports. With charge off specifically, there is a set of statutes that every consumer needs to be aware of, right? And without overcomplicating it or being too technical with it, I definitely know that it's important that they get this. So I want to make sure, hold on, that I am showing it just for them to screenshot, if anything. Can you see it? Yeah. All right. Now, this is the four-step process on how to properly challenge a charge-off. And the reason why I'm placing so much emphasis on challenging charge-offs is because something that most people don't know is most charge-offs that are reporting on our credit report, they are valid charge-offs, meaning they are that person's account. The account was charged off. I'm sure they did owe the lender, right? That's not what we are disputing. However, a part that is often misunderstood or left out is while most charge-offs are valid, most are not accurate. And there is a big difference between a charge-off being deemed valid and accurate. It's the difference of a person getting pulled over with an expired license. They have a license. It's their information, is their address. However, the status of that license makes it illegal, right? Like it doesn't matter that the information is correct. That's sort of the same thing that happens with charge-off specifically. Getting a charge-off removed from your credit report legally, I want to place emphasis on that, legally, and doing it the proper way can cause 100+ point increase in a person's credit score, and it does wonders for your borrowing power, especially if you are trying to buy a home, specifically trying to buy a home, trying to buy a car, or pursuing any sort of installment-based loan. Charge-offs affect those drastically. So it's super important that everyone knows how to properly challenge charge-offs, because those are, according to the most recent FICO report, charge-offs were actually the second largest quantitative item that was on consumers' credit report that contained derogatory accounts, which was insane. It's insane. This is the first time that's ever happened in the history of since I've been doing it. But there are so many illegal charge-offs that are affecting our credit reports. So as long as they follow these steps, which is getting a copy of their official credit reports and just going through this list, I don't know if you guys want me to read through it, but just going through this list, looking for 2 specific things. And
yeah. Let's go through, because some people might be listening to audio. They might not be able to see.
okay. Yeah. Perfect. Okay. Yeah, I can definitely do that. Okay. So, the statutes that everyone needs to be aware of, and that they will use in order to properly challenge a charge off, is called it's acronym as TILA, right? Now, this is the set of statutes rather, that is the Truth in Lending Act. So as an overview, it deals heavily with the acquirement of a debt, or how lenders are possessing a debt, more so than like reporting on a credit report. So the process in which a lenders use matters the most. If lenders fail to do prerequisite things before charging off an account, things as simple as sending you a letter in writing, a warning, right? Like, they legally have to do that. They have to send you a warning before they charge off an account. They have to give you a chance to bring the account current. They have to give you a chance to settle the account, and then they also, after these are 3 notices, by the way. And now also after that, before they report it to the credit bureaus, they have to have tried to contact you at least 10 instances, right? And I'm just going to say 90% of companies do not ever follow that process to the T. And the burden of proof is on them. So I always tell, like, don't even try to stress yourself out. Like, did they send me? No. The burden of proof is on them. So what you do is you utilize your consumer rights that are rightly attributed to you, and you request that they provide proof that they have done all of those things. Providing proof is demanding that they send proof of ownership, right? One of the other biggest instances with charged off accounts is the original creditor selling the account to a collection agency, but not properly withdrawing ownership of that account. I want to say, according to 2 years ago, I think it was somewhere along the line of like 63% of charged off accounts that were in the hands of collection agencies, they didn't even own them properly. Like, they did not legally own them. And although they was collecting on the debt, harassing citizens, they didn't even legally own them. All it would have took is, as a consumer, for us to demand what's called proof of ownership, and that account would have to legally get removed. Doesn't matter how much you owe it, like, none of that matters. So the number one thing is demanding that they prove the ownership of the account, demanding that these instances did not happen, which is interest being added after the account was charged off. That is illegal. That happens a lot. Late fees being applied after the charge off. That also happens a lot, because they'll add like attorney fees and things of that nature. They cannot do that. Incorrect balance calculation. So they're inflating it with interest and, like I said, different sort of fees. Happens a lot. Unclear breakdown. So, like, if they don't send you an itemized list of every single cent item on that account, they can't legally claim that you owe them that. So yeah, those are the main instances that a company would have to prove that is accurate. And like I said, over 70% of the times it's not. So use that information, use the statutes that's presented before you, and challenge that by sending a letter to the credit bureaus saying exactly what I said.
The more you know.
All
yes.
right.
Yes. Next tip.
Good to know. Good to know. And that happens usually based off of, like, when does those type of situations even happen, as far as?
So it usually takes about 6 months for an account to be charged off. So 6 months of failure to pay for an account. If you have a credit card that you have just let go of, have not made a payment within, a few months, a company will usually charge it off at 6 months. However, they can charge off an account as soon as 90 days, 90 days late, right? But most companies will wait until at least 6 months. So they do give you a while to make right on the account. However, even still, after they charge, because they didn't properly notify you and follow all of the steps that they are supposed to, a lot of them are not legal. And so, yes, that one is so important, because the amount of charge-offs that I see get deleted and removed from credit reports on a weekly basis by a simple letter is outstanding. I will never get over it.
Yeah.
So one of the another way that you can increase your credit score is by increasing your credit limits, because that impacts like your credit utilization, and it helps you to have the more credit you have available to you, then the higher your borrowing power is, and it just increases it just improves your credit profile all around, right? So one of the tips that I always recommend, and I love recommending, is increasing your credit limits before applying for new credit. So that seems so simple, but the reason why somebody should do this is before they apply for a new credit card. So if you know that you are applying for a credit card, before you apply for that credit card, look at all of your existing credit cards and see if you qualify for a credit limit increase. That's simply because you have to understand that every single time you apply for a credit card, your lender who you are applying with, they will take a survey of all of your current credit card accounts, and whatever your average limit is or whatever, they will base your approved amount off of what you already have on your credit report, right? That's one. So if you only have credit cards under $1,500, it's very rare and unlikely that a new lender would trust you with $10,000 or $20,000, right? It is always best to seek to first increase your current credit limits before you apply for a new credit card. In fact, a huge red flag to lenders is if your credit limit is not increasing. That is a red flag to new lenders, and often a reason why they will deny you for their credit card, because that's risky. Why have you had that credit card since, for example, 2009, and the limit is still $500 or the limit is still $1,000, right? This is why I tell everyone, when you have a credit card, there should never be a full year that surpasses that you do not have or have not received at the very least one credit limit increase, but really you could have received 2+, at least 2 a year. That is a standard operation on credit cards. How banking credit limit increases work, that is so standard. 2 is very minimal in the usual method, or I'm sorry, the usual frequency of a credit limit increase. So if you are not getting those, then that's number one, a red flag. But also 2, you need to request them. Don't just wait until the bank approves you for a credit limit increase. No, you have to actually apply for them. Most
Yeah.
you have to apply for them.
The credit increase actually helps because it lowers the utilization, right? So if I
Yep.
had $1,000 and now they raised it to 2, and I was using 10%, now that 10% is going down to 5, right? So
Exactly.
we gotta start looking in that standpoint. I'm glad you answered that, because my question was like, how often should you be applying for it? And if you are applying for it, does that count towards like inquiries, or is that not an inquiry at all?
It does depend on the bank. So some banks like Chase, it does cause a hard inquiry. But American Express, Citi, and Apple, and a lot of other banks, they won't. They'll do a soft inquiry, so it will not count towards your hard increase. However, don't I would not be concerned about getting an inquiry at the behest of like a request for a credit limit increase. That is not going to like impact you at all. And I like certainly don't let getting an increase stop you from pursuing getting a credit limit increase at the very least twice a year, because not getting a credit limit increase will do more detriment and harm to your borrowing like borrowing ability in the future. So you have to you have to increase your credit limits. You should be seeking to increase your credit limits, or honestly, like, what is the point of having a credit card? Like, you might as well just use your debit card. You need to seek to improve your credit, or I'm sorry, increase your credit limits. That is super important. It helps you all across the board. And it helps all of your future credit opportunities. Like, it helps all of your other applications. If your credit, because by the way, I don't know if people realize this, but when a lender sees our credit reports, they don't see the same report that we see when we are logging in on our credit monitoring app or downloading our credit report. We have a consumer facing report. So we are not privy to a lot of the things that they see. One of the things that they see is the last increase of that credit card. They can see the starting limit versus the limit that you have now. So obviously they can tell and will know if you have received an increase. It is actually a red flag. And when I say red flag, I don't just mean like, oh, they don't like that. When I say red flag, I mean like it works to your detriment. Like it puts you in a lesser category, qualifiable category than you would have been, otherwise. So a red flag to lenders is a big deal, and it absolutely makes a difference with all of our applications. So again, request your credit limit increase. There's no reason why you should not.
Yeah, I can hear it now. There's going to be somebody that got 4 credit cards and they're going to be like, I heard EYL and Shonda, they said increase my limits. Now I got 4 inquiries, but
Yeah.
you shouldn't worry. Just be
Yes.
mindful. Like you should. This is actually going to help you. This is going to
Yeah.
help you. Okay.
Yeah.
Quick, this is like a personal question. Like when you have an American Express card, right? A lot of times they don't really tell you your limit, but they just tell you got spending power.
Yeah.
How do you gauge like how much spending power you actually have? Like it's like you might try to charge something and like, well, denied. How do we gauge that?
Well, first of all, Troy, you stunned on the whole audience because you don't have a limit. You have a spending power because you don't have a limit on your credit card. That is not most people's reality. No, but no, but so that's a charge. So that American Express has charge cards and credit cards. A charge card does not have a limit, whereas, like I said, whereas a credit card has an established limit. The difference is your charge card does not report a utilization monthly, right? Which, speaking of, if you are a person that has a charge card and your credit score is low, you need to make sure that you have another credit card that has a reported limit, because your charge card doesn't help your utilization at all because it does not report a limit. And make sure you are not carrying a balance on that charge card that is a penalty. Like you can't carry the point of the difference between a charge card and a credit card is a charge card is for you to consistently recycle the balance. Like you should seek to pay off that account every month. Like it should never be a month that you are carrying that balance over unless it's like an emergency, simply because the interest rate on carried over balances on charge cards are astronomical. Like, because they're literally made for a person to rinse and repeat and recycle their balance constantly.
Gotcha.
Yeah. And so there is no set limit. So even if they say your spending power is like 15,000, you can be like, hey, I want to spend 40K, and usually they'll approve it. So yeah. Most people can't relate though.
They deserve it. They deserve to be rich.
Hey. Yes, and speaking of, the American Express Gold Card is like one of my favorite cards in the world, but also one of the best everyday cards that if you are responsible enough to pay your credit card back, I recommend that card to pretty much everyone. Like that's just one of those cards that I probably will never get rid of ever. So this is pretty much like an overview of like how getting a higher or pursuing a higher credit limit is. And a great rule of thumb when it comes to requesting a credit limit increase is, in my opinion, in my experience, the best banks to request a credit limit increase every 90 days, at least 4 times a year, once a quarter, are going to be American Express, Discover, Capital One, Chase, and Apple. Those are like the best banks to have a consistently growing credit limit, right? Also, there's no hard inquiry, so it's a soft inquiry. It will not affect your credit profile. And just as an FYI for people who don't understand how it works and they have one of these cards, when to request. For American Express, I request every at least 91 to 95 days for a credit limit increase. If you have a Discover has a annual cycle of doing manual reviews, basically like seeking to see if you deserve a credit limit increase at month 7, at month 11, and at month 14 of you obtaining that card, right? Capital One will check every 6 months. Chase will only check on request. And that's important to know because Chase is not stingy when it comes to credit limit increases. However, if you do not request it, then they don't give it to you. So you need to request it. For Chase, because they do a hard pull, I only usually do them twice a year. And then the Apple Card, you can ask for a credit limit increase with an Apple Card every month. Every month. And there's no limit to that. So yeah, I just wanted to touch on that because, like I said, increasing that credit limit is very important. Increasing the credit limit is super important. Which brings me to my next point, which was the utilization thresholds that I wanted to touch on when it comes to credit cards. Now, this one is, I feel like I discussed this topic ad nauseum because this is probably one of the biggest misconceptions in our community. And I did touch on it briefly earlier, but I wanted to give a visual to coincide with it. Why reporting a 30% credit utilization is the biggest myth and the biggest lie that we have been fed. Simply because, like I said, reporting a 30% utilization leaves so many points on the table and prevents so many opportunities for us to increase our credit score. So if you are a person that does not have at least a 700 credit score, you cannot afford to report a 30% utilization under any circumstance. Instead, in order to increase your credit score in the most rapid way possible by using the current accounts that you have without having to apply for anything else, a great rule of thumb is to change the way that you are viewing credit utilization. What I mean by that, whenever we are logging into our credit monitoring apps, we are seeing a utilization percentage that encapsulates our overall utilization percentage, meaning like it's taking into account every single credit card that we have on our credit report, and it's adding those numbers together to give what's called an aggregate utilization. So it's whatever your collective total credit limits are across all of the current credit cards that you have, that's going to determine your utilization. If you are a person who needs and wants to increase your credit score and get every single point that you can, every extra point that you can within the next 30 to 60 days, so within the next 2 billing cycles, if you need to start approaching your credit utilization in an individual aspect. That is the only way that we are able to get as many of those 165 points allotted for credit utilization as possible. And unless you individualize each credit card, then you will not get all of those points. And I'll explain. So most people do not realize that, like I said, not only are we graded for aggregate utilization overall, but we are affected in the balances that we report on each individual card. We actually lose points. So here are some guidelines and thresholds that everyone needs to be aware of when it comes to credit cards. This is so important. There are certain thresholds when it comes to credit cards that I warn against, and like I said, everyone needs to be aware of. It's three important tiers. Any utilization that you report on any credit card above 28.9%, right? You automatically will trigger a 10-point score reduction per card, right? So off the bat, any single credit card that you have reporting on your credit report over 29%, know that like that's a 10-point score reduction every 3 months that you leave it like that. Now, this does apply to individual cards. So if you have multiple cards that's reporting over 28%, you will individually get dinged. So add those up. If you got 5 credit cards and they're 50%, 30%, whatever, then you are individually being dinged about 10 points each per infraction every 3 months, right? So off the bat, that's 60 point. That's like 90 points within 60 days that most people aren't even aware that they're being dinged. Now, where it gets dangerous is any credit card that you have reporting over a 48%, that is extreme. You are being dinged about 25 points per card that you are reporting over 48%. You are being labeled as risky. So anything that you apply for, you are never going to qualify for their premier offers for anything that's considered good or only for responsible borrowers. You will not qualify if you have any card over 48%. To take it a point further, most prestigious banks will consider any card over 48.9% as maxed out. So not 100% like most people think. If you are reporting if your utilization that you are reporting is over 48.9%, American Express will deem that as a maxed out card. So you are being penalized the same as somebody who has maxed out their card at anything above 48.9%. That is extremely dangerous level. If you allow any single individual credit card to report over 48.9%, no, you cannot do that. You have to decrease that immediately, like the next billing cycle. Then the next threshold that's like is wraps. Above 98% is worse than getting a charge off. And this can be an active open credit card account. If you are reporting above 98%, you are in the worst possible signifier or risk level when it comes to borrowing power. It doesn't matter how good your credit score is. It doesn't matter how great your history is. Utilization refreshes monthly. So every month that you report that you allow that to report, it affects you every month, right? That's why it's so important when you are paying down your credit cards to do it strategically. The first thing that you need to do is pay down any card over 98% because the goal is to get all of your cards at least first under 98%, right? Once all of your cards are under 98%, you need to then seek to bring all of your cards under 48%. And then the ultimate goal is obviously to make sure at all times all of your cards are below 28.9%. And then doing just that, most people will see, you can see like 90 plus point increase within, like I said, 2 billing cycles by just ensuring that you are not infracting on any of these thresholds when it comes to your individual credit cards. So that's super important. And then
What about collections?
So collections are not considered an active account. They're considered a defaulted account. So a collection cannot ever be a positive account, and it will always be a collection regardless. Like if you paid it off, the only time a collection will stop impacting you is if it's removed from your credit report, right? So I tell people all the time, I'm glad you brought that up too. A collection account, the second that it hits your credit report, it has done the most damage that it will ever do to your profile. The second that it hits, it's done all the damage that it could ever do. Like it can't get any worse. It can't start affecting your credit profile more after that. When it hits your report, it did all the damage that account could do. And the only thing that you should focus on is either trying to challenge it to get it removed, trying to arrange a pay to delete with the lender in order to get a deletion as a result of paying the account off. And if you cannot get a collection account removed, if you cannot get a collection account removed, then the best thing to do is just focus on building credit. It's already done the damage. There are a lot of people who will have collections and think that they don't need to build credit or they should wait to build credit or wait to apply for credit until the account falls off or I don't know. They like wait for something to happen. But again, the damage has already been done. The only response to a negative account is a positive. Like the only response to bad credit history is building good credit. That is the only and ultimate response to it. That's the only thing you can do. So yeah, with a collection, it's done the damage. If you can't get it removed, then build around it.
Yeah, one of the most important things is staying updated, not only with your credit score, but obviously how things are being updated inside of credit, just the information around it, right? And so most people know the bureaus, TransUnion, Equifax, and Experian. It wasn't until like I bought a house like maybe 9 years ago that I saw that there was different type of FICO scores. I was like FICO 2, FICO 3, 4, 5, and each one was for something different, right? Like if I was trying to get a phone, that was for a FICO score. If I was trying to get a car, that was for like FICO 6. And when I tried to get a home at the time, it was FICO 7 and 8. I'm like, oh, what? Nobody told me anything about this. But now there's like a FICO 10. Talk to us about what this is.
Yeah. So FICO 10T is the newest version of our credit scores. Not only is it the newest version of our credit scores, but it is the most impactful and the most our credit scoring system and algorithms has changed since 1996. So pretty much for the bulk of most of our adulthood and all of the time that we have been dealing with credit, this has been the most landmark change when it comes to our credit report or our credit scores. And we definitely need to let's go into that. Let me briefly explain what it is. So FICO 10T, just a little behind the scenes, FICO 10T was a response to a failed FICO 9 scoring system. And FICO 9 failed because most lenders considered it too consumer friendly, because it was less penalizing on things like collections, medical collections, specifically low balance collections. It didn't penalize us as heavy as like our prior scores did. So basically the lenders was like, no, the scores, the credit scores are increasing too much. The average credit score as a result of FICO 9 on average within the United States increased to about 722, which required lenders to pay up, essentially,
better
right? They
rates.
didn't like that. So they vehemently rejected FICO 9. That's important to know, because when you see how FICO 10T came and see how lender friendly it is, it's like they just completely flipped the switch. And FICO 10T is completely lender focused, meaning that like it allows lenders to have a more detailed view and grade us more harshly on certain things that will cause most of our credit scores to decrease, by the way. But yeah, so FICO 10T is lender friendly, and it's because it includes what's called trended data, right? So the T in FICO 10T stands for trended data. Trended data is a video screenshot preview of our credit activities, our activity on each credit account for the last 2 years. That is so drastically different from how our standard credit scores has ever been made available, because the difference is all of the credit scoring models prior to FICO 10T, a lender was only able to see like a snapshot of our credit profile or our credit reports at the time of our application. So if I apply for a credit card today using the standard scores, a lender could only see a snapshot, a still shot of history, what my balances was on the day that they requested my credit report, what the status is of my credit card accounts, my utilization. They can only see my current stats based on my most recent generated credit report, right? With FICO 10T, instead of only just seeing 1 month's worth pretty much of history in detail, they're able to see a 24 months history of each account. Not only that, they're able to use that to determine and predict how we will behave for the next 24 months. So basically they have a 4-year span, 2 years being based off predictability, that they can use to judge us and to penalize us really for borrowing credit, meaning like it's going to be the justifier for lower credit limits, decreased credit scores, refusal of credit limit increases, justifying high interest rates, which is all the things that lenders seek to do because it makes them more money. Anytime that they can use anything to justify higher interest rates is what a lender would likes, right? And so with FICO 10T, because it gives them access to so much information at once, we have to be so careful moving forward, starting now, with the data trends that we are showcasing on our credit reports in a way that we never have had to prior. And I'm pulling up an example, but yeah, it's have you seen your FICO 10T score?
I'm going to be looking right after this, but I saw like the FICO 10T and the Vantage score 4.0. Those are two different things, correct?
Yes. So Vantage 4.0 is the fake version of FICO 10T. So if you notice, Vantage, they always try to emulate FICO, right? Like, because Vantage is the scores that we get for free. A lot of people refer to it as like the fake credit score because no lenders really like Vantage scores or pull Vantage scores. They prefer FICO. But Vantage anytime FICO comes out with a new version, Vantage will respond with their variation of the FICO's newest version, right? And so that is the same with Vantage. Vantage 4.0 is just a copy of FICO 10T, but it is important for one specific reason. And I'm trying to load the document to show, but yeah, it's better if I show.
FICO is one of my monthly subscriptions.
Yeah, so you do have my FICO. You can see your 10T score.
Yeah. I've been doing that, and it's one of those things like you just want to know. Like you said, it gives you a more detailed look, and it kind of lets you go back into history, right? Like I remember, I think I had a late car payment from like 2016, a couple of years ago, and it was still on there. So like every 7 years, obviously, those type of derogatories get waived from your account. But just watching it, knowing that like, damn, it's still on there as you're making all these other payments, and how that can weigh on you is it's tough. But it's good to see it because it gives you like you said, a detailed look, and it kind of explains what these other FICO scores and exactly what they're used for.
Yeah, no, it it definitely does. Do you see? Are you able to?
Yeah, I got it right here. Yep.
Okay, perfect. So here is an example of the differences between how each model will view and grade specific things. So FICO 8 is our standard score. It's the score that most of us are used to dealing with. It's the score that we see when we log into most of our credit apps. It's literally like the most used versions of our credit score for the last 20 plus years. The classic FICO refers to the mortgage score, specifically FICOs 2, 4, and 5. Now, the top two are our standard scores that we've been dealing with, and then the bottom two, which are FICO 10T and Vantage 4.0, are the new scores. So for paid collection specifically, typically with our standard scores, our FICO 8 considered paid collections over 100. It affected your credit score. So any collection account that you have on your credit report that has a balance of over $100, then it does lower your score. One of the only great things about the newest versions of our score, which is FICO 10T, is it does ignore paid collections. So if you have collections that you have not been able to get removed, if you pay those off by way of settlement or if you pay it in full, then that account will be taken out of the consideration of your FICO 10T score. So that's great news for people who have been affected by collections. Their FICO 10T score, if they pay it, it will increase as a result of that, right? And then let me see here.
Shonda, can you go back to that slide for a sec? Because and maybe you can clear this up for me.
Yeah.
So your FICO 8 could be a score. Let's say it's a 690, right? But that classic FICO 245, that actually could be different, right? So I'm saying that because I actually experienced that. Like I had a score, I'm thinking like, oh, I'm going to get approved for this mortgage. It was a pretty good score. And then they went back and looked at my classic FICO because that was for the mortgage. And it was drastically different. It was like, I think it was like 570 something. I'm like, wait. And I had to get an explanation on that. So they don't always have to be like the same, right? It definitely could be drastically different.
They're hardly ever the same. I tell people all the time, like if they are all the same, there would be more shocking to me to see all of them being the same, simply because each of those scores are based on a slightly different algorithm for a specific reason. So the classic FICO is a mortgage score, so they will grade installment based accounts more heavily than, let's say, like a FICO A score, which will consider like credit card accounts and your utilization more important than your behavior on a loan. So they will each score model will prioritize different things based on the industry that they are selling it to. So it's industry specific. If you are seeking a car, most auto lenders will pick FICO 6, which is our auto score. And all that it's just slightly different variations of the FICO score tailored to specific industries. So yeah, it's the classic FICO, which is the classic. It's the oldest version. It's the most antiquated version, and it's the hardest to increase. Like that score is the most stubborn score. But the great news is the new credit scores, FICO 10T and Vantage 4.0, it was actually approved to be used as the new standard for mortgage scores. So after second quarter of this year, the Federal Housing Association, they like any Fannie Mae loans, Freddie Mac loans, whatever, any government backed loans, they will only base our mortgage approval off of FICO 10T and Vantage 4.0. So we no longer will have to deal with the classic FICO scores. They're being completely just they're going away. Like they're being antiquated. Like no one will use those scores anymore after second quarter of this year, which is why it's so important that right now people are making the changes and are aware of FICO 10T and how it is going to impact us differently, because those are going to be the new standard. Like it's going to be the new standard across multiple industries, not even just mortgage.
And that helps a lot of borrowers, right? Because if I'm using a standard, my score is going to be high, I get a better interest rate.
Yeah, it'll help. It'll help. So it'll help if you have been responsible with building credit and making sure you pay your credit card back, making sure you're not getting collections and stuff like that. Then your FICO 10T score will likely increase. It'll likely increase. However, if you have not been doing that, then your FICO 10T score is absolutely going to be lower than the scores that you're used to dealing with because of the trended data. So trended data is so important because, like I said, if your trends are showing you sporadically are paying your credit card off, like 1 month you max it out, the next month you pay it down to 10%, the next month you report 20%, that sporadic utilization will cause a drastic increase in your FICO 10T because it's based on trends. What is your trends showing? If your utilization is not showing a negative incline in terms of the balances that you are reporting, then you will be penalized for that under FICO 10T. Another big change is if you are transferring debt across your credit profile. For example, like if you are using a personal loan to pay off credit card debt, a very common strategy that a lot of people use, FICO 10T actually will penalize you for that. So that's no longer going to help us, which that's a little unfortunate because a lot of people will take out like a loan in order to pay down their credit card debt or pay off their credit card debt because the heavy interest that's associated with credit card debt, right? Or to just stop that interest from mounting. That's a very common practice that has been used for ages, but unfortunately, FICO 10T views that as not you decreasing your debt. They just view it as you migrating the debt, right? Like, so they penalize you for that. If there's not a steady decline in your overall debt to income ratio, then you'll be penalized. You'll be penalized. So yeah, like it's a lot tougher on us because, like I said, you could have done something or reported a high utilization over a year ago, and that 1 month will still be affecting you for the next 4 years. And in case people don't understand, like as of now, our utilization refreshes every month. Utilization keeps or holds no record. So if I max out my cards last month and then this month I get them down to under 10%, I'm going to be accredited back all the points that I lost last month. Like it holds no record. Utilization is per month, right? As of now, not with FICO 10T. Now you have to worry about every single utilization that you have reported for the last 24 months because that will affect you for the next 2 years. So, yeah.
Well, that sucks. But one good thing, medical debt no longer part of the credit report. Yes.
Yes. Medical debt, any medical collection on your credit report under $500 automatically has to be deleted by law. Or if you settle or pay off a medical debt that was over $500, then it has to be removed. In addition to that, your doctor, your provider, they can't even send your a medical collection to the credit bureaus until they have given you at least 18 months to pay whatever you owe from the date of from your visit, right? So they have to give you 18 months to pay it. If you haven't paid it, if you failed to pay it and you owe them more than $500, that's the only case that they can send it to the credit bureaus. But most medical collections usually fall under $500 because most of them are like co-pays and stuff that people didn't pay. Those don't qualify for our credit reports anymore. So that's amazing. Like, yeah, that's awesome. So that's a plus for a lot of people.
How often should you check your credit score?
I mean, I believe that you should have credit monitoring so you're alerted if anything changes. No, you shouldn't expect like your credit report to change drastically monthly, but you should always be aware of what's going on, because if somebody is stealing your identity, is applying for things in your name, you should always have an eye on your credit report, even if you are only utilizing free credit monitoring apps like Credit Karma, right? Don't take the score that they're reporting as law. Like the score is not your FICO score. It's going to be off. Don't take that at face value. However, the components of your credit profile and the accounts and all of that, those are usually accurate. So in order to just keep an eye on your credit profile so you know what's going on, if you don't want to pay for credit monitoring like my FICO, get Credit Karma, get I don't even know, Credit Sesame. It's a lot of apps. Most bank apps will give us our Vantage score for free, but always have a eye on what's going on your credit profile. I will specifically recommend that at least twice a year, everyone pulls their official credit report. That is so important. Do not think that your credit monitoring replaces your credit report. Your credit monitoring app can only go back 2 years, and it only has, I want to say, 40% of the details of each account. Your real credit report is where you will get all the information per account, especially if you are challenging your credit report or are disputing the accuracy. Never dispute based on credit monitoring. Always dispute based on your official credit report, because there's, again, it's just a lot more information that you're able to make sure that is, validated. So at least twice a year to get your official reports, but have credit monitoring for sure.
There you have it. Anything else that we need to cover before we wrap?
I mean, I could go all day, but it's just like, I think that as long as they incorporate however many tips that we talked about today, each of those tips can cause 30 plus points increase in one's credit score. So as long as the person actually put them into action, do the things and follow the advice, then they should see an increase in their credit score. And it's one of those, like I said, those are tried and true methods. They work. Doesn't matter what your credit profile look like. It doesn't matter how bad your credit score is. Those tips work because they are based solely on how our credit scores are allocated in the algorithm. And it isn't like, there are no exceptions. There are no exceptions. There is no credit report too bad to repair, no credit score too low to increase. There is no such thing. The lower your credit score is, the more points you have to obtain. Like, the more points you can get. So the lower your credit score is, the more you should be trying to seek, and getting as many points as possible. And just one last point: the only way that you're able to overcome bad credit is by building good credit. There is no substitute. There is no workaround. You can't credit repair your way to good credit. You can't dispute your way to good credit. The only thing that will lead to good credit is the only thing that will lead to good credit is building credit. That's the only option. There is no reason to pay nobody to fix your credit. You can do it yourself, because the fixing and what will cause the most increases in your credit score, consistent increases, is building. And nobody can build for you. You have to build for yourself. So I think that's probably like the point that I want to drive home. Your credit score is the way it is, and is at the score that it is because maybe you just were not aware of how the credit scores are broken down. But there are very easy and actionable things that you can do to increase your credit score and see immediate increase within the next few billing cycles. Just do it. Stop paying people money to fix it, and just build your own credit.
Yeah, and we got time. This is the perfect time of the year, right? It's the top of the year. I know people are coming into some money, hopefully over the next couple months. That FICO 10 is a real thing. And so we have some time before that hits, because it's going to get a little bit tougher on us to clear this up, because this is one of those things. If you're trying to get a home loan, if you're trying to get a car loan, if you're trying to get a cell phone,
within the next 2 years. So you don't even have to be in the market right now. If you know you about to buy houses in the next 2 years, you need to absolutely be making sure that you are in line with FICO 10T, because that's going to determine if you get approved or not 2 years from now. So,
Whew.
yeah.
We appreciate all the information. How can the people get in contact with you, follow you on social media, all that type stuff?
Shonda Martin on pretty much every platform. If you want more detailed information about the topics that we discuss, I typically pick one topic and do a full webinar on. And they're all available for free on my YouTube channel. And yeah, just search me on YouTube, like especially for the FICO 10T video specifically. Everyone should go watch that, because I broke it down and told you every single thing that's going to change, everything that you can expect, how to prepare for it. So that's super relevant and important for now. But I also address most other credit topics as well. And I do full webinars. They are free. The only thing I want in exchange is like you applying the steps. Please don't just view and not do. Yeah. So just apply them, and then that's it. And pass it on to a friend or a family member. That's it.
Yeah. And if you're in EYLU, Shonda was like, she overextended herself. She did a 3-part series for us, right? She came back 3 times and it was incredible. So again, we thank you. Always a wealth of information. And again, like you said, the information is on us. The application is on y'all.
Yep.
All right. So let's make sure we execute.
Yeah. All right. Well, thank you guys for having me.
No problem. No problem. All right, guys. There you have it. Another great episode under the belt. So make sure you utilize all this information. Vitally important.
Yes, yes, yes.
All right, we'll see you guys later.